Hi, good morning. My name is Pete Cataldo, Managing Director in the Healthcare Investment Banking Group at Truist Securities. I run our firm's Medtech practice. We have a great panel this morning. We're going to be talking about the M&A environment within the Medtech space. And I'm just thrilled to be joined on stage here by Jeff Martha, Chair and CEO of Medtronic, Rachel Ellingson, Senior Vice President of Strategy at Zimmer Biomet, and Deepak Nath, CEO of Smith & Nephew. So thank you, everyone. So the first topic, we had a very strong start for the M&A environment early this year with J&J's acquisition of Abiomed, Globus announcing their acquisition merger with NuVasive. But overall, the deal volume in the sector is down 65% in the first half of the year. So first question, we'll start with Rachel. What are some of the factors that drove this slowdown in activity, and do you see it picking up in the second half of the year?
Yeah, sure, thanks. By the way, and thanks for the opportunity to be here. I'm excited for this topic. It's a topic I love, near and dear to my heart. I think the slowdown, to me at least, has been more around the uncertainty out there, right? So you got rising interest rates, which clearly impacts financing. You've got volatility. I think volatility in stock prices always hurts M&A because I think it's really hard to have a good valuation discussion, particularly with public companies. If their valuation's been reset, it takes them a little bit of time to decide whether that's truly a reset or not, right? 52-week highs aren't that far away from where they are currently. So I think you've seen stock price volatility. And then I think just rising costs in general in an uncertain environment can make companies just take a closer look internally and a look at their capital allocation practices and all of that. I think that mix is all in there for why it's been down. But I do want to say I think I'm probably one of the more bullish that it starts to come back. I'm a believer in that larger companies need growth at their core and need growth at the size and scale that actually moves the needle. And I think without acquisitions, that's really hard to do.
So just how about activity levels now? I mean, Deepak, are you seeing a pickup in M&A activity?
I wouldn't say the back half of the year, not from my vantage point. Of course, we've got our own set of considerations in terms of how we look at it. We're executing a turnaround in one part of our business, right? 40% of our business. So we've got a particular set of circumstances for us that kind of paces how we look at kind of near-term M&A. But having said that, all of the factors that Rachel mentions have been a clear overhang in the sector, and it's not like, the last couple of months have been great to the sector, right? So in terms of our ability to kind of execute, I think is diminished now, a couple months in, compared to the first half of the year. But longer term, I do share Rachel's optimism around deal volume coming back. M&A has always been a source of value creation in Medtech. Whether it's larger deals, the sort that Rachel, you and I were part of, or tuck-ins and other things. So clearly, growth is a factor in Medtech, despite all the focus on margins that we see today in the sector. Growth is a key part of it, and there's only so much you can rely on internal sources of growth. So I think the long-term view is good, and I share Rachel's optimism. I think short-term, we've got to get through some of the overhang from GLP-1 and all the other factors that have been, plaguing some of the Medtech sector.
Well, let's talk a little bit about valuations, because Rachel, you mentioned stock market volatility. Valuations have pulled back pretty materially this past year, specifically. Companies that the larger caps within the space, the high growth med techs are trading just under 7 times forward revenue. They're off 30% this year. So maybe question for you, Jeff, is that driving more actionable M&A opportunities within the public markets for Medtronic? And then also, how's that translating into private valuations?
Well, first of all, I think the volatility that Rachel's describing, and Deepak mentioned it, that does play a factor. So yeah, valuations have taken a pretty big hit, but then they've come back and they go down. I mean, there's a lot of volatility, and for us at least, we're looking at, and I think maybe some of the other large companies, same thing. We're looking at the long term, And the volatility matters, the ups and downs, but we're looking at an asset for a long period of time and trying to understand that strategic fit. It's a little up or down isn't going to dramatically change our decision, but overall, obviously, the volatility does impact. And to Rachel's point earlier, I think this current kind of overhang on valuations, I'm not sure a lot of the companies aren't convinced that this is going to last. And so, they're not, some of the targets that we would look at, they're they're saying, hey, this isn't our valuation. And so they're clearly not, there. So I think that's impacted. And I think interest rates on the private side, interest rates is clearly having an issue. The higher interest rates are impacting valuations on the private side as well. But look, for Medtech, I mean, obviously M&A is a big piece of what we do. And I think, just hearing these two, and I would concur that especially the large cap companies are looking at M&A strategically, and I'm optimistic about the future.
Rachel, how about you? Are you seeing sort of an impact on private company valuations?
Yeah, I think the difference with private companies in some ways is they're not marked to market every day, right? So sometimes, and they might be more open to structure. So sometimes you can actually get to fundamental value and have that conversation in a way you can't always have with public companies, especially if they've fallen pretty significantly. So I think that's probably a positive. But I do think they're probably, if they're in need of cash, so their cash position is certainly going to be something they're going to have to factor in. I think I've heard at this meeting a couple of times people saying, a flat round is the new up round. So that's definitely something that's going to weigh on them and potentially cause them to, and the lack of an IPO market, of course, all of that cause them maybe to pick up their head and think now is a good time versus maybe taking on the dilutive financing and waiting for an IPO market.
Just one thing to build on that, during COVID, we had these valuations go down, and the capital markets were passing out free money, and so I don't think that's going to happen this time. So if this kind of new valuation paradigm sticks for a long period of time, I don't see I don't see banks lending money for free like they did. I think the cost of capital is going to be high, and that will definitely impact private companies if this hangs around for a while.
Well, let's just talk about the acquisition activity at both Smith & Nephew and Medtronic, because you really for the last couple of years you've been fairly quiet from an activity perspective. So Deepak, maybe over to you. What's driving some of that lack of activity over the past 2 years?
I think for us, it's been, our time coming out of COVID has been challenged for us, particularly for the orthopedics business. So a lot of management attention, my attention since I've been here, has been on making sure that we're taking the steps we need to take to put that business on back to a strong footing. That said, there are two other businesses that are 60% of our revenue base that are actually working well, they're performing well, and we're spending the time on that piece. From a M&A standpoint, as Jeff said, we all have our lists. We have companies we're in discussions with and companies in our target list, and there's a process we go through to refresh our thinking and the discussion. So to your point, to Jeff's point, these are long-term kind of considerations, and we haven't taken our eye off the ball. But in the end, it's about trying to make a transaction happen, and the forces haven't quite lined up. But I would say, coming from a Smith & Nephew standpoint, other than the exogenous factors and kind of the ability to do a meaningful transaction in the time period that you're talking about, there is the factor of the challenge that we have in one part of our business. So those are some of the things that have influenced kind of what our structure looks like. It's not to say that we're taking our eye off the ball in our target list, so that we don't have a list of targets or things that the discussions that we're having with potential companies. So that hasn't waned in these 2 years.
Jeff, how about over to you at Medtronic?
Yeah, I'd say, look, our activity, I mean, maybe not as visible to you, but our activity's been, we've been pretty busy. I just golfed with our head of M&A, Chris Cleary, and his handicap is still very high. Mine's worse, but his is pretty high. I see him back there. And the team's been busy. And you know, first of all, I'd say on the deals that you see, the count is lower, right? But the amount of money we're spending is in line with historical trends pre-COVID. In our FY23, it was $2.5 billion or something like that. It's in line, but the count is lower. We are definitely, for a variety of reasons, looking to do more impactful, fewer deals, but more impactful in the short term. Meaning, you're going to feel them in our P&L earlier. And so that raises the valuation a bit, and they've got revenue, et cetera. So that's one focus, that's one area. The other area that you're not as visible is we do a lot of structured deals with private companies, where we, have a, investment, call option, strategic partnership, all that. So a lot of those, our venture activity, venture portfolio, very active there. And finally, we've been working on a couple of divestitures. We did a joint venture for the renal care business with DaVita, and we've announced a pretty large spin of our patient monitoring and respiratory interventions business, and so that's been taking a lot of time. So the activity is there, a little bit on the divestiture side, and a lot of venture and structured deals as well with some fewer but larger deals on the M&A side.
Well, you brought up the topic of corporate divestitures. I mean, I think this active portfolio management amongst the large caps have been really prevalent since really the start of COVID. So this is the trend. Rachel, I know Zimmer spun off your spine and dental business. So, but would love to sort of get your perspective. I mean, how did you think through the different options that were available to Zimmer Biomet in? Number one, why divest those businesses? How did you identify those? And then how did you think through the options?
Yeah, so if you start with why first, I think everyone should be always looking at their portfolio, right? And for us, focused on making sure we're increasing the amount of revenue we have in higher growth markets. That's very critical to our strategy and what we're looking to do. You look across and you look at the health of your businesses and determine first, are they high growth businesses inside, and are they in high growth markets? Then you layer onto that you make capital allocation decisions inside of your businesses and across your portfolio. And unfortunately, sometimes those businesses that are non-core or lower growth areas don't get as much capital, which then continues kind of the vicious cycle of their not getting the investment always that they deserve. You manage some of those businesses differently. So then you get to a place where I think you have to say, are we the right owner, or is someone else a better owner, or are they better off on their own to control their own destiny? And so I think that's kind of, at least for us, the thought process we went through when we realized that those businesses, good businesses, just not getting the attention and the resources that they needed to be as successful within our umbrella. So, and then in terms of the why spin versus divestiture, which is I think what you're asking for us, I think the difference is, of course, you've got a highest certainty of execution with a spin. So you control your own destiny. There's no counterparty you're negotiating against. So I think just that high level of execution, one transaction, you don't have to do multiple transactions. Some of that went into it. And it's a nice tax efficient vehicle, actually, for creating value for all stakeholders. So that's pretty well sums up where we were.
And then, Jeff, maybe one of the divestitures that you announced was the partnership with DaVita for your renal care business. That was a very unique structure. Can you talk a little bit about the rationale behind that?
Sure. I mean, I think one theme that we're looking at Medtronic right now is we have a lot of exciting investment opportunities, whether it be the soft tissue robot or diabetes or structural heart or the list goes on. Hopefully, renal denervation, we'll see. So, we have, I think, too many. And so on the renal care side, particularly this home dialysis, very exciting technology that we uncovered from our cardiac surgery business as a filtration technology for home hemodialysis. And there's some other products in the portfolio very exciting. But We just didn't think at the end of the day we were the best ones to bring that to market. We don't have a channel for that, and it just wasn't as core. So we very excited about the technology. We think it's a lot of valuation. We thought DaVita would be a better partner, a better company to take that. So this partnership, that's how we got to this partnership there, and really excited about it and committed to getting this technology to market.
Well, it's again a creative structure, and I hope that goes well. You talked about the venture portfolio at Medtronic, and maybe a question for Deepak. Just on the strategic investment activity, are you seeing more opportunities today? How is Smith & Nephew thinking about making strategic investments? We know you've been active in the past. And maybe talk a little bit about what criteria do you use to evaluate those opportunities? We do get asked a lot from our private company clients about bringing in strategic investors.
Yeah, so first of all, definitely see opportunities, right? It's a great time to be in Medtech. Over the last day in various panels, we talked about a lot of advancements in technology, whether it's in materials, in biologics, AI, digital. There's a lot going on, and harnessing all of these technologies for the good of the patient, that's what we do. So at a fundamental level, there's lots of opportunities, and we've been in many discussions, quite structured, quite programmatic in terms of areas. We've got an interest, obviously, like many of our peer companies in the whole digital landscape. We have a particular interest in biologics, and our last deal in biologics the last two deals have been quite successful for us, remains an area of interest. So very excited about the prospects, very excited about the opportunities there are. In terms of the criteria, we're all looking for sources of growth. Right? That's the first filter. The second, you've got to answer, well, why is a particular bit of technology or an asset better in your hands versus somewhere else? That's obviously a very fundamental question. And you overlay kind of where you're looking to go strategically. So there's the whole business unit kind of lens to it, and there's the overall corporate lens to it. Something like biologics, touches multiple of our business segments, right? So you clearly need to have a holistic strategy around that that's, beyond what you may want to do in any given business. So that's an overlay. Are there threads that you can connect across your different businesses? So things like platform-based technology. So that's another lens that we bring into it. And then finally, time frame. Jeff talks about kind of his imperatives, the way he's looking at it. Investments to enter into P&L. We're all looking for a similar set of things, but obviously there's the practicalities of what you're willing to pay and your ability to pay for these types of things. And finally, from a technology standpoint, in MedTech, there's a time scale for development, and so when you enter into these things, you've got to layer on risk, technical risk, clinical risk, market risk. And you have to ask yourself whether you've got the fortitude and the ability to make those long-term investments over time. So it's not kind of a near-term commitment over 1 or 2 years, but more programmatic. And what's your risk tolerance relative to some of the other things you're looking at? And that lens or the consideration is different for one company versus another, right? I know there's a way that I'm looking at it now, just different to the way I've looked at it in my past couple of lives. So it's very context dependent, very company dependent. But those are some of the factors that we look at and I'm looking at in this current role.
Jeff, how about at Medtronic? You've got a very active venture investment portfolio. You had mentioned, one theme I'd like to explore is just, you'd mentioned some rights and all different variables of rights with these investments. Are you always looking for some sort of rights with the venture investments, or what's your perspective there?
No, we actually separated, after the Covidien merger, we actually separated our M&A team from our venture team. Okay, they're very linked, but it is distinct. And when it's a structured deal like that, that's more on the M&A side. So the venture side, we operate this out of our Boston office. We act like a pure, a venture company. Yes, we're focused on areas that Medtronic views as strategic to us. So that's one difference than just a pure play life sciences venture fund. But other than that, we try to, and if an asset, after we invest in it, we've deemed, hey, that market's not for us, then we want to behave like a responsible, venture investor, and we shift our focus to, maximizing our, keeping our reputation in the market and maximizing our return. So it's, so we're not, to answer the short answer, when it comes to venture, we're not looking for those rights. I think that, makes us less competitive. Would we like a board observer seat? Yes. But that's no other rights is the usual ask.
One of the panels yesterday talked about having multiple strategic investors in a particular company. Is that a turnoff to Medtronic or a non-factor?
I don't know that it's a non-factor, but I wouldn't say it's a turnoff. It's something we pay attention to. It validates it in many regards. If you have a competitor that's that you respect, that's deep in a particular space, and so we're often find ourselves investing. Maybe we're the first one in, and then another strategic comes in, or vice versa. There's already one of our competitors in there, and we come in because a lot of times we're looking to learn as well, and so it's a factor, but not necessarily a no-fly zone, and it's quite common actually.
And how are these opportunities sourced? I mean, what's your advice to the private companies in the audience that are looking to attract Medtronic as a strategic investor? What's your advice to those companies?
Well, most of my background's on M&A, not venture. By the time they get to me, I'm not sure how they get there. But no, like I said, we have a team that's in that venture world, and I'll be honest, that's not my area. But the things we're looking for, all the things that Deepak mentioned. I mean, for us again, strategic to us, but beyond that. We also look at a couple of things. What is the makeup of their cap table? Are these, companies or people we can work with? We don't need that kind of dysfunction. Sometimes in these venture scenarios, you get a lot of dysfunction at the board, and we don't. Life's too short for that. One thing. We're looking for the content here. Sometimes some of these, companies come with, with a bunch of buzzwords, like they're going to put AI on everything, and that's a yellow flag. I mean, we want the content here, and the other thing I'll say, like if one thing that raises a skepticism, especially like a lot of things are connected today, right? Like the days of Medtech companies building standalone widgets, whatever they are, I think are kind of coming to an end. Everything's connected, even orthopedic implants have sensors on them now, right? But if you're coming in and your value proposition is based on, hey, I'm the platform that the whole world is going to organize around, that's a big one. And I think we got to start thinking about how you're either a convener or you're part of a larger ecosystem you've got to plug into, and I think you've got to think about that and also factor in, hospitals do not have the bandwidth to integrate with all these different point solutions. So these are things that were those are I wouldn't say no-fly zones, but those raise flags, so that'd be some of the advice that I give. Quality of investors, quality of your board, and, kind of easy on the buzzwords.
Good advice. Let's move on to early stage M&A. It appears that large caps in this environment want to see more commercial momentum, whether that be 10 million, 20 million, 50 million of revenue before an acquisition in this current environment. So I guess maybe Rachel, over to you. I mean, how does is that a fair statement in this environment? How is Zimmer thinking about that? What's your criteria when you're looking at earlier stage businesses?
I think for us, earlier stage, bigger, we use the same decision criteria, right? Is it mission-centric? Is there a path to leadership? Is it what we say, WAMGR accretive markets, just meaning, is it going to increase the amount of revenue you have in higher growth markets? Is it revenue growth accretive? And is there a path to EPS growth, right? So those are kind of, whether it's venture, partnership, early stage, later stage, I think it's the same criteria. And then you just really have to assess, okay, how much capital is available? You prioritize across those opportunities. What kind of capital do you have? What's your risk return? So I think some of the stuff Deepak mentioned, right, regulatory risk and reimbursement risk, and those are the things. And are we the right owner? And return metrics, financial impact, and then you just kind of have to say a little bit of, is the juice worth the squeeze? Because the earlier stage deals, we do plenty. I mean, we have been also very active, probably have done 20 deals over the last 5 years. But you definitely want to make sure it's just as hard to integrate a larger deal, a post-commercial, than it is to do an earlier stage deal. So I just think you have to be, the bar might be a little bit higher, but I don't know that I would say we wouldn't do pre-commercial. We've done pre-commercial. We've certainly, the partnership you mentioned on smart implants, right? Like, I mean, we do those. But I think it has to be, you have to look across all of the opportunities and prioritize against a lot of different things.
Deepak, how about at Smith & Nephew?
It's very, very similar, Rach. I would say it's not a distinction per se. Obviously, as you look to mitigate as many of the risks as you can, having a little bit of revenue allows you to better judge, whether market acceptance risk or clinical risk. So to the extent that it helps you kind of get to a different kind of risk profile or fits better with the risk appetite you're willing to take or have on a particular deal. But it's not a hard and fast kind of filter in terms of our decision making. Just like Rachel and Jeff, we look at a whole range of opportunities, and I wouldn't say there's been a particular shift, at least in our thinking, around pre-commercial versus post-commercial.
And Jeff, how about pre-approval businesses? You made an interesting comment to me yesterday about they're absolutely not off the table. There are certain areas where you're willing to take more risk versus less. I mean, can you talk about that a little bit?
Yeah, sure. I mean, before I jump right into that, I'd say just on there, particularly in this point in time right now that we're in, with high interest rates, and for those of us that are global, the strong dollar has put pressure on margins in this moment, right? And so when you're looking at deals, taking on a super dilutive deal that's pre-revenue or or just very little revenue, it's a little more challenging as we sit here today. But so I just want to add on to that. This will work its way out, I hope. Interest rates should come down, we hope, inflation. But on certain areas, we are more comfortable on pre-approval. So like areas that I would argue that we have very good, deep domain expertise, and these are super high growth areas like structural heart, right? So if you're looking at some new valve, we know that catheter, based valves, whether it be TAVR or mitral or we know that those are going to be big markets. The patient impact is so clear, the health economics are so clear, and we feel we can. There's always risk in those deals, but we feel we have a good enough from an engineering and perspective and our understanding of the hemodynamics of the heart. We feel we can make those bets, and we may be wrong, but if we wait till after it's approved, I mean or after you get more data, your pivotal trial and approval, the cost just goes way up. So in certain circumstances where it's a high growth market, we're well positioned, we feel good about our team, we'll take more risk on a pre-revenue technology. But if it's like a new business model or something like that, it's much harder. And then you start thinking, I want a little revenue to validate it. Like I think that's what Deepak's point was, I believe.
So Deepak, let's. What is the board sentiment for M&A, and specifically larger M&A? I mean, what's the sentiment at the board level at Smith & Nephew right now?
Look, I think there's recognition on my board that there's a important role for M&A in Medtech. I mean, to state the obvious, you got to find deals that deliver value and all of the things that you have to get through that. But there's definitely recognition on our board that M&A is a key part of it. And in fact, when you look at the structure, the strategy that I've articulated, we've put M&A as a key component of our strategy. And we haven't spelled out whether it's large or small or what have you, but it's a key part of our strategy. So I'd say there's recognition of the importance of it. And, as in life, everything's about timing and the planetary alignment. And so we'll see how the things shake out.
Jeff, how about at Medtronic? I mean, clearly the tuck-in M&A is going to continue to be a strategy at Medtronic, but how about some of the larger deals?
Like I said publicly, as we sit here, and for the past couple of years, in the foreseeable future, tuck-in M&A is our focus. We did the Covidien deal a few years ago, for a variety of reasons. But since then it's tuck-in, and we define tuck-in as for us, one definition is different than another. But for us, it's clearly something that's either could fit in the bag of an existing sales force or is like a near adjacency, not too far away adjacency, and dollars, mid-single digit billions and below. That's kind of how we're thinking it. And that's the focus. And as in terms of board sentiment, our board, just like Deepak was saying, understands that M&A is a critical part of Medtech. Matter of fact, we've been spending over the last 2 or 3 years a lot more time on M&A in the boardroom. Some of it used to be like tucked away in a finance committee. It's now in the main board, and we spend on portfolio, on M&A. We spend a good chunk of our general board time every quarter on this because it is so strategic to growth, as both my esteemed colleagues here have pointed out.
Well, great feedback, great panel. Thanks everyone for being here, and thank you especially the panelists. So,
Thank you.
thanks again.
Thank you.
Thank you.